Right now, as we head into 2026, something significant is unfolding in the American housing market. While some cities continue thriving, others are experiencing turbulence that's catching both homeowners and investors completely off guard. If you're thinking about buying, selling, or investing in real estate in the coming year, understanding which markets are under the most pressure could save you from a costly mistake. Before we dive into these 10 critical markets, make sure you hit that subscribe button and tap the bell icon so you don't miss our upcoming analysis on where the housing market is actually heading in 2026. The story unfolding isn't one of universal collapse, but rather of selective strain. Certain cities that experienced explosive growth during the pandemic years are now facing a difficult reckoning as economic realities continue to shift. Elevated mortgage rates, evolving migration patterns, and stretched affordability are creating pressure points that vary dramatically from one market to another. Let's explore the 10 metros where these forces are converging most intensely as we move into the new year. Number 10. Denver, Colorado. The mile-high city built its reputation on stunning natural beauty, a thriving tech ecosystem, and a lifestyle that attracted ambitious professionals from across the country. Between 2020 and 2024, home prices surged more than 50%, transforming Denver into one of the priciest interior markets in America. The median home now hovers around $600,000, a figure that seemed justified during the remote work boom when high earners flooded in from coastal cities. But as we close out 2025 and look toward 2026, the narrative is shifting. Inventory has climbed 38% year over year, and the average home now sits on the market for 75 days compared to just weeks during the frenzy. With mortgage rates holding in the 6.5 to 7% range, the math has become challenging even for well-paid tech workers. A typical monthly payment now exceeds $4,000, and that's before property taxes and insurance. The vulnerability here isn't immediate collapse, it's stretched affordability meeting economic uncertainty. If the tech sector experiences significant layoffs in 2026, or the flow of relocating professionals slows further, Denver could see prices adjust 15 to 20% as sellers compete for a shrinking pool of qualified buyers. For those who purchased at the peak with minimal down payments, that could mean owing more than their home is worth. Number 9. Sacramento, California. Sacramento marketed itself as the sensible alternative to Bay Area prices, and during the pandemic, that pitch worked brilliantly. Families and remote workers fled Silicon Valley's million-dollar starter homes for Sacramento's comparatively reasonable prices. Values jumped over 40% in just 2 years as demand overwhelmed supply, with the median peaking around $540,000. Today, as 2025 winds down, that median has dropped to approximately $450,000, representing a $90,000 decline. Inventory has surged 46% year over year, and price reductions have become common rather than exceptional. The challenge is straightforward. Sacramento's appeal was always tied to being the affordable escape, but with mortgage rates still elevated, a $450,000 home requires an income that exceeds what most local families earn. The Sacramento Metro median household income sits around $75,000, which means the typical family is increasingly priced out of home ownership even after recent declines. The migration from the Bay Area has noticeably slowed as remote work policies have tightened and tech sector adjustments have reduced the pool of relocating buyers. Sacramento experienced significant pain during the 2008 crisis, and its current combination of slowing demand, rising inventory, and affordability challenges creates echoes of that earlier downturn heading into 2026. Number 8. Tampa, Florida. Tampa represented the Florida dream during the early 2020s. Warm weather, growing job opportunities, no state income tax, and home prices that hadn't yet reached Miami levels. The combination proved irresistible. Remote workers, retirees, and notably institutional investors converged on Tampa, pushing average home prices to $383,000 by 2022. By late 2025, prices have softened to around $360,000, but the more concerning signal is inventory, which has exploded more than 55% compared to the previous year. Homes that once received multiple offers within days now linger for 75 to 90 days. The short-term rental market, which absorbed significant investor capital during the boom, is now oversaturated. Thousands of Airbnb properties are being converted back to traditional sales as profitability evaporates. With mortgage rates remaining elevated, the monthly cost of home ownership has increased dramatically, even as prices have moderated slightly. Tampa's rapid appreciation outpaced local wage growth, creating a gap between what homes cost and what residents can actually afford. The investor retreat is adding inventory faster than traditional buyers can absorb it, and that imbalance suggests further price adjustments may be necessary in 2026 before equilibrium returns. Number 7. Bakersfield, California. Bakersfield was never supposed to be expensive. Its entire value proposition rested on affordability, offering refuge to families priced out of Los Angeles and the Bay Area. That humble positioning made the pandemic boom all the more dramatic. Prices rocketed from around $240,000 in 2019 to nearly $440,000 by 2022, an 83% increase that fundamentally transformed the market. The problem is that Bakersfield's economy didn't transform alongside its housing prices. Local wages remained largely flat while home costs nearly doubled. At one point, nearly 25% of purchases were made by investors and flippers anticipating continued appreciation. That speculative element is now unwinding as many of those investors list properties at substantial discounts just to exit their positions. With mortgage rates around 7%, a median-priced home now carries a monthly payment exceeding $3,200, a figure far beyond what most Bakersfield families can manage on local wages. The city's median household income sits well below $70,000, creating a fundamental mismatch. As we head into 2026, if inventory continues rising and outside buyers remain scarce, Bakersfield could see prices retreat significantly toward pre-pandemic levels, potentially erasing years of gains for recent buyers. Number 6. Dallas, Texas. Dallas became synonymous with corporate relocations and economic opportunity during the 2010s and early 2020s. Major companies moved headquarters to the Metroplex, bringing high-paying jobs and spurring massive residential development. Prices appreciated 60 to 80% since 2020 in many submarkets, particularly in the northern suburbs where new construction boomed. Now, as 2025 ends, the market is showing clear signs of oversupply. Inventory has jumped 45% year over year, and homes are averaging 75 days on market. Price cuts are increasingly common as sellers adjust expectations. The scale of Dallas's growth is both its strength and its vulnerability. Thousands of homes were built on the assumption that corporate relocations and population growth would continue indefinitely. If that assumption proves overly optimistic in 2026, if tech sector employment contracts or corporate expansion plans are postponed, Dallas faces a surplus of housing without sufficient buyer demand. The investor activity that characterized the boom is reversing, adding to inventory pressures. Dallas isn't facing immediate crisis, but its trajectory in the coming year depends heavily on employment trends and whether the economic momentum that fueled its rise can sustain. Number 5. Sedona, Arizona. This stunning mountain desert town, famous for its red rock formations and vibrant arts community, became a highly sought-after destination for affluent buyers and retirees. Its unique appeal drove median prices to around $850,000 at the peak. But as we approach 2026, Sedona's luxury market is experiencing a notable correction. Sedona's housing market was fueled by external wealth, a continuous influx of affluent buyers seeking second homes or tranquil retreats. However, economic uncertainty and elevated mortgage rates around 7% are drastically curtailing this specific buyer pool. High net worth individuals are delaying luxury purchases, and discretionary spending for second homes or investment properties has diminished. Inventory has surged over 35% year over year, and homes are now sitting for extended periods, averaging 100-plus days on market with a rising percentage of significant price cuts on multi-million-dollar properties. The market is seeing an investor retreat, particularly those in the short-term rental sector who can no longer generate acceptable returns. The high cost of living, including steep HOA fees and rising wildfire insurance premiums, further stresses homeowners. For those drawn by Sedona's charm, the housing market presents a precarious investment heading into 2026, where the dream of a peaceful retreat has encountered financial headwinds as the boom has cooled considerably. Number 4. Las Vegas, Nevada. Las Vegas thrives on calculated risk, but the housing market bet made during the pandemic isn't paying off as expected. From 2020 to early 2022, median home prices shot from $290,000 to over $460,000. A staggering 58% spike driven by out-of-state investors and historically low interest rates. By late 2025, the cards have turned, and Vegas is showing signs of a significant correction. The market is experiencing a notable slowdown. Inventory has more than doubled in the past year. Homes that once sold within a weekend now sit for 3 to 4 months. Price reductions are widespread, with over 40% of all listings now discounted, many by $50,000 to $150,000. The primary culprits are overbuilding and excessive speculation during the boom years. That speculative investor class is now in liquidation mode. Rents are dropping and Airbnb income has dried up significantly. Mortgage rates, stubbornly above 6.5%, have transformed once hot Vegas homes from prized assets into financial burdens. Even more concerning, local wages never justified the frenzied price run-up. Las Vegas remains heavily reliant on tourism and entertainment jobs, making the market exceptionally sensitive to broader economic conditions. As we enter 2026, should current conditions persist, home values could regress substantially, with some analysts suggesting a 30 to 40% correction from peak prices is possible in certain submarkets. Number 3. Boise, Idaho. Boise isn't just experiencing a housing downturn, it's become a case study in how quickly a pandemic boom can reverse. Few cities match the explosive growth Boise experienced between 2019 and 2022, when median home prices soared from $285,000 to nearly $575,000, a remarkable 100% increase. But what rises rapidly can fall substantially. By late 2025, the initial cracks have widened considerably. Inventory has exploded, and homes that once vanished in bidding wars now sit for 140 to 150 days as demand has dried up. Boise was flooded with new residents and investors during the boom, especially remote workers who bid up prices aggressively. Many of those properties are now underwater or barely breaking even. With rents falling and mortgage costs remaining elevated, the financial equation no longer works for many investors. Some are now selling properties at significant discounts just to mitigate losses. Simultaneously, local families are being priced out. With interest rates above 6.5%, the monthly cost to buy a median-priced home exceeds $3,800. Another pressure point is overbuilding. The city's outskirts feature numerous subdivisions with substantial unsold inventory. Foreclosures are rising again. Looking toward 2026, experts suggest Boise could face a 40 to 50% price decline from peak levels, potentially returning home values closer to pre-pandemic levels. Number 2. Cape Coral, Florida. Once marketed as Florida's affordable waterfront paradise, Cape Coral is now at the center of the state's housing adjustment. During the pandemic, prices exploded with the median home price shooting from around $230,000 in 2020 to over $470,000 in 2022, an astonishing 100% increase. But as 2025 ends, Cape Coral's housing market is experiencing a sharp reversal. The area experienced massive overbuilding. Developers flooded the region with thousands of new homes, but now many sit empty or struggle to find buyers. Builders are offering substantial discounts and incentives, but buyer interest remains weak. Cape Coral also suffers from skyrocketing insurance costs due to increasing flood risk and hurricane exposure. Premiums have more than doubled, with some policies exceeding $9,000 annually, making even modest homes financially challenging. Simultaneously, property taxes are rising and HOA fees are increasing as associations build reserves. This combination is triggering an exodus of retirees and investors. Listings are soaring, with inventory 3 times higher than in 2022. Over 50% of homes have experienced price cuts, and days on market have doubled. Looking into 2026, should these pressures persist, Cape Coral could see home prices fall back substantially, marking a 40–50% decline from peak levels. What was once a dream destination now presents significant financial challenges. Number 1. Phoenix, Arizona. Phoenix isn't just experiencing a housing downturn, it's rapidly becoming a focal point for the 2026 housing adjustment, eerily mirroring its role as an epicenter in 2008. Few cities in America match the explosive growth Phoenix experienced during the pandemic housing boom. Between 2019 and 2022, median home prices soared from $280,000 to nearly $510,000, a staggering 82% increase. But by late 2025, the landscape has changed dramatically. Inventory has quadrupled, an unprecedented glut, and over 55% of listings now feature price reductions, some by $100,000 or more. Homes that once vanished in bidding wars now languish for 90 to 120 days as demand has evaporated and investors race for the exits. Phoenix was flooded with investors during the boom, especially institutional buyers who acquired thousands of homes, often sight unseen. Many of those properties are now underwater. With rents falling and mortgage costs remaining elevated, the financial math no longer works. Some investors are dumping properties at fire sale prices just to limit losses. Simultaneously, Phoenix locals are being priced out. With interest rates above 6.5%, the monthly cost to buy a median-priced home exceeds $3,800, while average household incomes haven't kept pace. Many prospective buyers have simply given up. Another critical pressure point is overbuilding. The city's outskirts in areas like Buckeye, Queen Creek, and Maricopa are littered with subdivisions, struggling to sell units. Builders are offering massive incentives, dragging down comparable sales in the process. Foreclosures are rising again, particularly among buyers who stretch their finances with low down payments. Looking into 2026, experts suggest Phoenix could face a 40–50% price decline from peak levels, returning home values closer to pre-pandemic norms. In many ways, this echoes 2008, but potentially with broader implications because the overvaluation is more widespread and economic headwinds remain strong. Phoenix isn't just declining, it's leading the adjustment. The bottom line. As we head into 2026, the housing market story is one of regional divergence. While some cities continue performing well, these 10 markets face genuine challenges stemming from overbuilding, stretched affordability, investor retreat, and changing economic conditions. The markets that soared highest during the pandemic years are now experiencing the most significant corrections. For buyers, this creates both risk and opportunity. Patience may be rewarded with better prices in the coming months, but careful due diligence is essential. For sellers in these markets, realistic pricing and flexibility will be crucial. And for investors, understanding these regional dynamics could mean the difference between profit and significant loss. The American dream isn't disappearing, but it is adjusting to new economic realities. Builders are reassessing, buyers are being more selective, and investors are taking a more cautious approach. So, if you're looking to buy in these markets in 2026, be cautious, be informed, and be strategic. Not every sunny forecast reveals paradise. Some markets won't recover for years. Don't forget to like this video, share it with anyone who needs to see this crucial information, and, of course, hit that subscribe button for more in-depth housing market analysis. We'll see you in the next video, because sometimes knowing where not to buy can be the best investment decision of all.